As we pivot to the U.S., we want to look at what is happening with the U.S. product supply. And you can see that we moved up slightly on the back of jet and disti. So we went from 13.73 to 13.99. But it's still at a very low end from where we were expecting. We were expecting to be at about 14.5, 14.4 on the average. But the average keeps getting pulled down just because of the lack of demand on the disti side. We already expected gasoline. Gasoline isn't a surprise to us. The big drop in distillate has been exponential at this point when you look at where the drop has come, because our view is that you were going to get that drop in trucking. That was very much something that we've been discussing. This swiftness of the drop in trucking was a bit surprising, and the lack of any real stabilization has also been a bigger factor. We are getting much colder in the U.S., which will provide some uplift, but given where trucking is, it's unlikely to see a meaningful increase in distillate, which is the biggest difference between 2021 and 2022. Because you might look and say, well, 2021 was closer to normal. Where's the difference? And again, distillate is the biggest difference between the two, and that's where we continue to see some of those issues. As we said last week, we thought that the diesel crack was the one to buy. We have a chart showing you that was the correct move. Unfortunately, we think that has now had a run. So, if anything, I would just flatten that out. I don't really have much opinion on distillate at this point, just because the cold has now been baked in. You have a lot of problems with trucking. You have some of those builds in storage, which is going to create a bit of an unknown as we go into year end. Distillate had a build of 1.36 million. You can see here that Pad 3 had a small build, but is well over the 5-year. Pad 1 had a nice build of 2.31 million, but it's still 14.6 million below the 5-year. So again, Pad 1 continues to be the issue. Imports slowed slightly by 94,000 barrels a day. All of that was driven by Pad 1, but a lot of that is timing. We do see some additional movements coming through. So that's going to be an interesting one to watch as well. But you can see that we're still elevated. There's still going to be imports increasing into Pad 1 just because we don't have a meaningful way of getting it from Pad 3 into Pad 1 well and above the Colonial Pipeline, which is going to, again, keep us importing into the East Coast. Here you can see that we've moved much closer to where we were at the bottom end of the cloud. But when you look at the breakdown, the fact that we're now still on the low end of storage, the biggest drivers of that normalization is because things are fairly stable from Pad 2 to Pad 5. Pad 2 is going to get a bit worse. You had a draw of 1.29 million. With the loss of Canadian crude, that should accelerate because you're likely going to see some run cuts just as that crude starts to dry up a bit, and you should see some additional pull from from storage. Now, when you look at that bounce, here you can see we went from about 43 and we're back up to about 57 on the diesel front month crack spread. It's likely to come down a bit. This move higher, a lot of this is pricing in China reopening, the cold snap. So it's unlikely that we get much movement back above 60. But there is some staying power here. It's just I think that there's an opportunity to reload at a point a bit lower. When you look at Pad 1, the builds have accelerated. A lot of this is on the back of imports as they've picked up. But you can see the rate of change has increased more so than other years. But obviously, we're still at a 29-year low, and we don't see that changing into year end because storage is really going to flatline at this point and likely drop as we get that increase in demand for the colder weather coming through the rest of the year. Pad 3, right back to where we were in 2017. You can see that we're right around where we were in 2017, 2009, and 2020. And we don't see, again, there's a lot of staying power here just because refiners are going to operate, and it's just going to be a matter of how much can they push into the exporting market, and which is going to keep us right around these levels, which, as you can see, is very much closer towards the top end of the range in Pad 3. Distillate demand bounced, as we were saying, it was going to have a bounce. It's still going to stay well below the 5-year average. It's just bouncing really very much close to the normal seasonal levels. So we do expect to see this move a bit higher, especially as it gets colder. But we still see a lot of things being underwhelming on the distillate side, keeping us well below the 5-year average. We got a small bounce in trucking, but nothing meaningful. It's still at a very low end. And when you look forward at some of the data, here's a good one in terms of container import volumes. You can see just how we continue to drop. We're now back below where we were in 2019. A good quote from FreightWaves, container imports, November 2022 had the greatest October to November decline since 2016. At 12% as volumes trend back to 2019 levels. And for those that have been following us since 2019, we were not bullish in 2019. We actually said that those volumes were not a good setup for heading into the end of 19 and into 2020. And the same still stands here. So this is more of a slowdown on an economic side, which is going to impact diesel, which again, we see as a bigger issue going forward. Holiday uncertainty is interesting. So when you look at small and mid-sized businesses are worried about demand swings, decreased demand, their biggest concern, 50% saying that that's a problem. Insufficient inventory, 35%. So there's still those inventory concerns. Shows about 85% of respondents are worried about a swing in demand up or down, impacting sales or inventory. So that's going to be an interesting one to watch to see how that plays out, because if the decrease in demand happens, that'll show up in retail sales. That's showing that the consumer's finally kind of giving up the ghost, if you will. And that speaks poorly for where we're going to be as we head into Q1 of next year. On the rail side, we had a nice little pickup in carloads. We're now 1.3% above where we were in 2021. That is on the back of an increase in coal, which again, guys are scrambling to make sure that there's coal stockpiles ahead of the surge in demand, electricity demand. But then when you look at motor vehicle, non-metallic, metallic, we do see some bounce in grain and forestry products as well as farm products. But chemicals, again, petchem is terrible, and we don't see petchem getting better. Petchem is going to be an overhang. We do see some recovery in petroleum and petroleum products. Intermodal is going to be a struggle just because we have those slowdowns on the economic side. So realistically, it's coal, farming, and motor vehicle that are going to kind of keep us where we are. As intermodal, it gets better. At 5.8% on the low end, we do expect that to bounce a bit, but definitely not towards the where we were last year. And a lot of this is when you look at the signal data coming from into California. Things have gotten a little bit better, but we're still at the very low end of the range when you look at some of those flows. And when you reverberate back, we don't see a huge backlog, which again just points to that slowdown on the freight side, which we continue to see. Here's a lot of support on why we saw those moves in natural gas and distillate. You can see that the outlook has gotten colder, and as you go further out into December, a lot of that cold shifts even further into New England, where you have a significant amount of purchases and homes that operate on heating oil. So again, this is just showing you a lot of support for distillate, propane, and natural gas. A lot of that has been priced in. Now natural gas is actually coming down because Freeport is still has some issues on the restart based on FERC demands, and we'll talk more about that in the FSC show. Now you look at gasoline. Gasoline had a build of 4.5 million. We're only 5.8 million below the 5-year, which getting much closer to normal. So a lot of that is only driven by PADD 1. PADD 1 is still fairly low. But then when you look at blending components had a huge surge of 5.26 million, and we're now well above the 5-year average. And as we've been saying, blending components is a very good indicator of where things are. Nice increase in imports. We had a big bounce of 271,000 barrels a day in imports. That was driven by PADD 1 with an increase of 256,000 barrels per day. That's well above the 5-year. And if you look globally speaking, Pad 1 is the only place that still has a lot of storage capacity available. Europe is at a record high. Singapore is at a record high. Fujairah keeps climbing. So realistically, Pad 1 is your best option. And that's where you're going to continue to see some of those movements. And that's, again, you're seeing it in gasoline storage on how quickly it is closing that gap, because demand is very low. Imports are accelerated. And as refiners continue to target distillate, you inherently throw off gasoline, which is going to result in bigger builds into the market. Blending components inventory here, you can see that there was a big surge. We're going to take out the 2020 high. That is just driven based on lack of demand, lack of petrochemical demand. So then the options are, well, am I going to consume it in the petchem stream, or am I going to put it into the gasoline pool? And right now, because of the weakness in petchem, a lot of that is going into the gasoline pool. Gas Buddy data, U.S. gasoline demand fell 2% from the prior week and was 1.5% below the 4-week rolling average. And they had modeled about 8.36 million barrels a day. Again, we see this just between that 8.3.5 to 8.5. We will get a bounce as we go into Christmas. Typically something closer between 8.6 to 8.8, just given where we are, what is normal. Clearly, we're going to be below normal, just given where the data sits right now. But you will get a little bit of that seasonal bounce. China had that spike, but you can see that it's dropped back off. We don't expect to see a huge surge in the reopening as some others do. And the reason why is because what do we know when there's a reopening and people are contagious? You have a massive surge of cases. And you don't need the government to tell you to stay home if there's a surge. People are going to look at this and say, well, I'm not going to risk it. I'm just going to stay home and avoid things that I don't have to do. And that's, again, going to keep things a bit depressed. And then the question is going to be, do people stay home for Lunar New Year? Do they try to travel? And because if they travel more, you could see a much bigger surge just based on the contagious nature of it. Or you'll see this people saying, look, let's give it another year. And that'll keep it very much under wraps. North America still remaining slow. Asia Pacific rolling over a bit. Europe slowing down a touch, still at a higher end. We do expect to see some of that drop as things slow down into kind of a dead week next week. You'll get a nice pop for Christmas, and then that'll drop off. And we do see some overhang as we go into January. Increase in imports and slowing demand has done well for gasoline. You can see that we're back to the highs from 2021, sitting at $3.21. Given where storage is, where imports are, where blending components are, there's likely more downside to pricing. Here you can see that diesel prices are back to where the low point for 2022 at about $4.85. Given the cold snap, we should get a little bit of support, but not like a bounce. It's just more of a flat line. And you did get a small increase in diesel in trucking, but not a huge one. So it's more along the lines of staying at $4.85 and less about a movement back higher. Here you can see that gasoline demand dropping off. We will get that spike, and you can see that we normally get that spike closer to about, on a normal basis, anywhere between 9 to 9.2 million, which is why we think we'll be something closer to about 8.6, 8.8, likely closer to 8.8, and then that'll drop off, and we're just going to remain very much underwhelming compared to other years. Propane, propylene, we had a build of 660,000 barrels. That's 11.7 million above the 5-year. We're above the 5-year across the board. The only time we had more storage was 2016. The cold snap will help drop this down, but again, exports are remaining strong, but production is robust. And so you have a lot of supply and you don't have a lot of local demand with the issues in the petrochemical side, which is going to continue to be an overhang. Jet fuel had a draw of 1.49 million, 2 million below the 5-year. You got a nice spike in demand as you had that product moving into position. You can see that just based on where it falls, it happened a little bit earlier than previous years. which is really of no issue. It's just a matter of, you average it out, it's going to come back to our range of 1.45, 1.55. TSA passengers are showing that things are moving, as we've been saying, better than 2021, not as good as 2019. And we are going to continue to see that play out over the next few weeks. And then passenger side flight schedules weeks ahead is 0.23% higher than it was last week. Number of passenger flights over the week of December 6th to 12th remain relatively unchanged. So we don't see much movement up or down when you look at the activity, keeping us very confident in our numbers for jet fuel demand. And then when you look at open table, you can see that there's been an accelerating down move in open table activity in the U.S. That's just a mixture of the cold weather. I feel like everybody has the flu. All three of my kids now have the flu. My wife took Tamiflu to avoid the flu. So we continue to see that rip through. So between pricing and sickness, you're going to continue to see that move to the downside, and as the consumer starts to slow down into year end. So that's what we have for you in the U.S. On the next segment, we're going to go deeper into what happened with OPEC, what happened abroad, and some of those key international bellwethers.